In 2026, Kenya faces a nearly $1 billion revenue challenge. To address it, the nation proposes new taxes on mobile phones and banking fees, aiming to trim its fiscal deficit to its lowest in a decade. This move highlights the delicate balance many emerging economies strike between public services and fiscal responsibility. For years, Kenya has grappled with mounting debt. The International Monetary Fund, or IMF, has consistently urged fiscal consolidation, pressing for measures to increase government revenue and curb spending. This external pressure often translates into domestic policy shifts that directly affect citizens. The planned taxes are not just about collecting funds, they represent a significant policy pivot. By targeting mobile phones and banking fees, the government aims to tap into sectors with broad penetration, ensuring a wider tax base. This strategy, however, risks impacting the very people it seeks to serve. Mobile money platforms like M-Pesa are integral to Kenya's economy, enabling everything from remittances to small business transactions. A tax increase here could disproportionately affect low-income earners and small enterprises, potentially stifling the digital economy that has driven much of Kenya's recent growth. The government's goal is ambitious: to reduce the fiscal deficit to its lowest point in 10 years. This requires disciplined execution and careful projection of revenue streams. The success of these new taxes hinges on their ability to generate significant funds without triggering widespread economic slowdown or public backlash. Banking fees, another target for new taxation, impact everyone from individual savers to large corporations. While seemingly small, cumulative fees can add up, especially for frequent transactions, the government is betting that the necessity of banking services will make these taxes stick. The implications extend beyond Kenya's borders. Other developing nations facing similar debt burdens are watching closely. The success or failure of Kenya's tax strategy could influence how other governments approach fiscal consolidation, particularly in leveraging digital services for revenue generation. So, what does this mean for you? Whether you're an entrepreneur, an investor, or simply a consumer in an evolving global economy, here's what to do with this. First, for businesses operating in emerging markets, always model a 3-5% increase in operational costs related to transaction fees and digital service taxes. Kenya's move shows that governments will increasingly look to these areas for revenue, so build that into your pricing and profit margins from the outset. Second, if you're an investor, pay close attention to government fiscal policy announcements in countries where your portfolio companies operate. Changes in tax regimes, especially on widely used services, can directly impact consumer spending power and, by extension, corporate revenues. Look for explicit deficit reduction targets and how they plan to achieve them. Finally, and most importantly, understand the tax elasticity of essential services. Kenya is testing how much its citizens can bear on mobile and banking fees. For any business, this means continuously evaluating how price increases on your core offering might affect customer retention. Small, incremental changes are often more sustainable than sudden, large ones. Monitor competitor pricing and customer sentiment closely.